Nobody loses money by earning more. That sounds obvious, but every year millions of Americans turn down raises, refuse overtime, or panic at year-end bonuses because they think crossing into a higher tax bracket will somehow cost them. It won't. Here's why the math never works that way. Tax brackets in the United States operate on a marginal system, which means the rate only applies to income inside that specific range. Your entire paycheck doesn't suddenly get taxed at a higher percentage when you earn one more dollar. Only that extra dollar, and any others above the threshold, face the new rate. The money you earned below the line stays taxed exactly as it was before. This design exists to make the tax code progressive without creating cliffs where earning more punishes you. Other countries use similar systems, though the rates and thresholds differ. The principle remains the same. Income gets sliced into layers, and each layer pays its own rate. Marginal tax rate means the percentage applied to your last dollar of income. If you're single and earn $60,000 in 2024, your marginal rate is 22% because that's the bracket your top dollar sits in. Effective tax rate means your total tax divided by your total income, the real percentage you pay overall. That number will always be lower than your marginal rate because earlier dollars were taxed at 10% and 12% before you ever reached the 22% tier. Think of it like a stadium with ticket sections. The first 11,600 seats cost $10 each. Seats 11,601 through 47,150 cost $12. Seats above that cost $22. If you buy seat number 60,000, you don't pay $22 for all 60,000 seats. You pay $10 for the first chunk, $12 for the middle chunk, and $22 only for the seats in that top section. Your average price per seat, your effective rate, ends up much lower than $22. Here's how it works with real 2024 brackets for a single filer. The first $11,600 you earn gets taxed at 10%. That's $1,160 in tax. Income from $11,601 to $47,150, a span of $35,550, gets taxed at 12%. That adds $4,166. Income from $47,151 to $100,525 gets taxed at 22%. If you earn exactly $60,000, only $12,150 of it sits in that 22% zone, which costs you $2,127. Add those three amounts, $1,160 plus $4,266 plus $2,827 equals $8,253 total federal income tax. Divide $8,253 by $60,000 and you get 13.8%. That's your effective rate. Your marginal rate is 22%, but you're only really paying 13.8% of your total income in federal tax. Now suppose you get a $5,000 raise, bringing you to $65,000. The first $60,000 still gets taxed exactly as before. Nothing changes in those lower buckets. The new $5,000 sits entirely in the 22% bracket, so you pay $1,100 in tax on that raise. You keep $3,900. Your new total tax is $9,353. Divide that by $65,000, and your effective rate creeps up to 14.4%. You're now paying a slightly higher overall percentage, but you still took home an extra $3,900. You didn't lose money. You didn't even lose a large percentage of the raise. You simply paid the marginal rate on the increment. The confusion comes from two places. First, people hear you're in the 22% bracket and assume every dollar gets hit at 22%. That's never true. Second, paycheck withholding can make it feel like a big jump. Employers use tables that estimate your annual income and withhold accordingly. A single large bonus might trigger withholding at 22% or even higher because the system assumes that bonus-sized paycheck will repeat all year. It won't, so you'll get the excess back at tax time when the actual math reconciles. Your withholding is not your final tax. It's just a prepayment guess. Another misconception. If I earn $1 over the cutoff, I'll owe thousands more. False. Earning $100,526 instead of $100,525 moves one single dollar from the 22% bracket into the 24% bracket. You pay an extra 2 cents on that dollar. That's it. The $100,525 below the line remains unchanged. There are no cliffs in the federal income tax structure where crossing a threshold costs you a lump sum. Some benefit phase-outs, like certain credits or subsidy eligibility, can create effective cliffs, but that's a separate issue from bracket mechanics. A third confusion point. People conflate marginal rates with other taxes. Social Security tax is 6.2% on wages up to $168,600 in 2024, then zero above that. Medicare is 1.45% on all wages, with an additional 0.9% on wages above $200,000 for single filers. Those thresholds work differently. They're flat rates on ranges, not stacked brackets. When someone calculates their real marginal rate, they sometimes add the income tax rate, the Social Security rate, the Medicare rate, and state income tax together. That combined number can be high, especially in states like California or New York. But it's still a marginal rate applying only to the top slice of income, not a retroactive penalty on everything you've earned. One edge case worth knowing: the alternative minimum tax, or AMT, which runs parallel to the regular system. If your AMT calculation exceeds your regular tax, you pay the higher amount. AMT uses different brackets, 26% and 28%, and disallows certain deductions. High earners in states with steep local taxes sometimes trigger AMT. When that happens, your effective marginal rate can jump because losing a deduction effectively raises your taxable income. But even then, earning more never leaves you with less cash after tax. The AMT just flattens the progressivity slightly. Another edge case: income phase-outs for deductions and credits. If your income crosses the threshold where, say, the student loan interest deduction starts to disappear, you lose 10 cents of deduction for every extra dollar earned in that range. That loss doesn't directly add 10 cents to your tax bill. It removes 10 cents of income that would have been shielded, but it does raise your effective marginal rate temporarily. Some phase-outs create bubbles where your marginal rate spikes to 25 or 27%, even though the statutory rate is 22%. These are real but temporary. Once you're fully through the phase-out range, your marginal rate drops back to the bracket rate. State and local taxes layer on top. 9 states have no income tax. Others use flat rates or their own bracket systems. A few cities, New York City, San Francisco, add municipal income tax. Your combined marginal rate is the sum of all those rates applying to your next dollar. But again, each piece is marginal. California's top state bracket is 12.3%, but that only hits income above $698,271 for a single filer. If you earn $700,000 in California, you don't pay 12.3% on the whole amount. You pay 1% on the first chunk, 2% on the next, and so on, just like the federal system. One more wrinkle: capital gains. Long-term capital gains and qualified dividends have their own brackets, 0%, 15%, 20%, that sit separately from ordinary income brackets. But the thresholds interact. If your ordinary income sits at $47,000 and you realize $10,000 in long-term gains, part of those gains might be taxed at 0% and part at 15%, depending on where the breakpoint falls. The IRS stacks ordinary income first, then layers capital gains on top. Your marginal rate on the next dollar of wages might be 12%, but your marginal rate on the next dollar of realized gains might be 0% or 15%. They're separate systems that share the same form. To summarize, tax brackets work like buckets stacked on top of each other, each taxed at its own rate. When you earn more, only the new income that spills into the next bucket gets taxed at the higher rate. Everything below stays where it was. Your marginal rate is the percentage on the top bucket. Your effective rate is the weighted average across all buckets. A raise will always leave you with more money after tax, even if a slightly higher percentage of that raise goes to tax than the percentage you paid on your earlier income. The system is designed to avoid punishing you for earning more. You can accept the promotion,